Our top story, global bond markets underlining some concerns.
We're just seeing a big risk-off scenario.
The mood music of slowing growth.
The usual flight to safe havens.
Worried about the economic condition going forward.
Uncertainty in the economy.
If everybody thinks the yield curve inversion results in a recession, then investors will behave accordingly and make it happen.
What you're seeing right now in the bond market is caution.
Deflation is a tail risk now, not inflation.
People feel the need to buy that deflation hedge.
To flow straight from equity straight into bonds.
Yields in the U.S. are coming off.
Interest rates probably aren't going up.
Yields are lower outside the U.S.
Weakness in foreign economies that has kept foreign bond yields lower.
An increasing number of people seem to expect a downturn, if not a recession.
What we're going to see is a much more bumpy ride in both equity and bond markets.
Joining me around the table here in New York is Stanley JOHCM Senior Fund Manager, Andres Garcia-Amaya, Zoe Financial Founder and CEO, and Bob Michael rounding things out for us, JP Morgan Asset Management Global CIO and Head of Global Fixed Income. Lale, I want to begin with you. The great global bond market rally of the last couple of weeks. What's your take?
It's been good, but I think it's the valuations are getting overextended in our opinion, and we're not getting paid for duration. So we're still invested in credit, but we're staying short and sweet.
What do you think, Bob?
I think it's magnificent. I think that the Fed...
I knew you were going to say that, but carry on, please.
Of course. I'm a career bond investor. This is wonderful. After 3 years of raising rates and running down the balance sheet, the Fed has called a truce on us bond investors. You're supposed to buy every backup.
Andres?
Yeah, I think the Fed has basically now told us that they're more worried about deflation than inflation, and they're willing to see inflation actually on the upside. So I think for bond markets, investors, that's probably a good thing.
So, Bob, what is your takeaway from the yield curve inversion that we saw very, very briefly between the 3-month and a 10-year on Friday?
I'm concerned. We were dismissive of 2s, 10s inverting, and everyone looked at 3-month to 10-year. It's a powerful story. If the global universe of bond investors is willing to put money out 10 years and take a lower yield than they can get rolling over 3 months from the same creditors, they're seeing something at the grassroots level.
You're concerned, but you're still willing to be fully allocated to a credit risk story. How do you reconcile those two things?
Because right now, I think everything looks great in bonds. I think we've seen a Fed that's willing to be agile and unconventional. I wouldn't be surprised if we get into the latter half of the year, the Fed continues to run down the mortgage portfolio and reinvest in the front end of the Treasury portfolio to try and maintain a steep curve.